All right, so welcome back. So in this training, you're going to learn about annuities. Now we're going to dive deep into annuities because here's the thing, annuities is one of the most difficult parts of the life insurance exam. Most students who fail actually perform poorly on the annuities section of the life insurance exam. So this is a very long training. So we're going to divide it into multiple parts, okay? So strap yourself in. Make sure you have a pen and paper or your notebook to take notes. Watch the entire thing from beginning to end. If you're listening on the podcast, you want to listen to the entire thing from beginning to end. So see you in the training. All right. Good morning, everyone. Here we have a special addition here to our VIP community. We have Mr. Eddie from the great state of Georgia. He's just joined us. So Eddie, welcome. And as usual, we have here Josita. So she's joining us. Eddie, again, full disclosure, he failed his exam once, and I'm here to help him make that his last time. He's going to pass his exam. And then, of course, we have Josita here. So Eddie, you want to introduce yourself for those who are listening here for the first time? Anything you want the people to know about you?
Okay, my name is Eddie. I'm based in Georgia, and I've written the exam before, but I lost about 5 points, so I don't want to try on my own again. So I'm here to get the knowledge and get it done this time.
I'm going to pull up your exam outline.
Okay.
I'm going to pull up your exam outline side by side. So Josita is from Maryland. So we have the Maryland outline. So now let's pull up the Georgia. Have you downloaded your state exam outline yet?
Yes.
Okay, perfect. So Georgia life insurance exam outline. All right, perfect. So we're on annuities. All right, so perfect. So this is for Georgia. There's annuities for Georgia. And this is annuities for Maryland. Okay, so far I'll show you what we've covered, and I'll just review that one more time quickly for you. So we've covered 6.1, which is annuity principles and concepts. So on Georgia, that single level, so it will be this one. We have not done fixed and variable yet. We'll do that. We have not done index. We've covered accumulation period. We have not done payout periods yet. So I'm going to review that for you quickly. And you see, so when I go over the concept, then we'll do some practice questions. So I'll send you the practice questions also. I send that to her, but you don't have it. So I'll send you the practice questions. It's about 60 questions just on annuities. So when we finish those 60 questions, we go over them, the material, then I'll send you additional 200, let's say between 200 to 400 questions just on annuities, right? So if you do 200 to 400 questions just on annuity, trust me, I mean, you're going to understand annuity so well, no matter how to twist and turn it, you're going to get it right. And usually on the exam, annuities is what gives people a hard time. Annuities and the taxation of life insurance. So make sure you do, if you score above 70% or let's say 80% in both of them, you have a good chance of passing. So we did this one, accumulation. We did this one. Okay. So let me go ahead and just explain that to you here. So let's review this quickly. So annuities. Okay. First of all, I want to see how much you know, right? Because sometimes I tend to explain too much. So if you know a little bit, then I won't go into too much detail. So tell me everything you know about accumulation period versus annuity period for annuities. This is for you, Eddie.
You said accumulation period and what?
Versus what's the difference? Compare and contrast annuity period versus accumulation period. This is on your exam outline, accumulation period and annuity period. So compare and contrast in your own words.
I would say accumulation is what's the right word to use now? Is the period of let me write what to use. Well, I say the period where you accumulate the cash you're trying to save,
Mm-hmm.
like the cash you're trying to save for yourself. That's the period where they are being I don't want to use the wrong word. Just explain.
Okay. So let me take you here. Uh, let me show you my screen. Okay. Okay. So let's start with, first of all, what is annuity, right? Uh, yeah. So even though it's not on your exam here, the use of annuity, no, but I want you to know it. So what is annuity? Annuity is, you can write this down. You have a pen and paper, right?
Yeah.
Okay, perfect. All right. So annuity is, you got to know, number one is an insurance product. Okay. So annuity is an insurance product. Number two, annuity is sold, because it's an insurance product, it is sold by insurance companies. Okay. So annuities is an insurance product, it's sold by insurance companies. What makes it an insurance product is because it practice risk pooling. Risk pooling, pooling, risk pooling. What does risk pooling mean? Risk pooling means that in annuity, uh, first of all, what is risk? I think this would be, let me check your Georgia exam outline. Let's see if they have it here. Risk. I'm sure Maryland. Okay. Okay, risk classification. All right. So risk pooling pretty much means that anytime you have any insurance product, whether it's annuities, life insurance, car insurance, it doesn't matter, right? First of all, risk is the potential for loss. Anytime there's a potential for loss, that's considered risk. So, for example, life itself is a risk. Why? Because there's always the potential for death. Okay, so life itself is a risk because there's potential for death. So let's, again, I'm going to, because once you understand the fundamentals, you understand the basics, then as we build up, you're going to understand these terms. Because chances are they're not going to ask you what is risk, or they're not going to ask you what is a loss or what is a peril, right? But they're going to ask scenario-based questions that require you to understand the definitions of those words if you're going to get them right. So risk is the potential for loss or the chance of a loss. Number two, what is loss? Loss, the insurance definition of a loss is just a reduction in value, or reduction in, to be specific, financial value. So, for example, the reason death is a loss is because when you die, you're a financial asset to your family, right? So let's say you're making 100,000 a year. You're bringing 100,000 in your household, right? But when you die, now your family does not have that 100,000 coming in anymore, right? So that's a financial loss. So because of that, death will be considered a loss. For example, if you drive a car, you have car insurance. If your car is involved in an accident, right? Now your car value has decreased. No, let's say your car is involved in an accident and it's total. And that car was worth, let's say, 30,000, but because it's involved in an accident, now that car is damaged. So now it's no longer worth 30,000. Maybe it's worth now 5 or 10,000, right? So that's a reduction in financial value. So anytime there's a reduction in financial value, it is considered a loss. Third thing, peril. What is peril? And this will also be on your exam from Maryland. Maryland, I know, asks all these. So you can write this down, Josita. So what is peril? Peril is the direct cause of a loss. So, for example, if you are driving and you get into an accident, okay, now let's break it down. So you're driving itself is the risk, right? Because anytime you're driving, there's potential for an accident, right? You can do everything right, and someone could just slam into you, right? So there's always potential for loss when you're driving. So driving itself is a risk. Now, let's say you get in an accident. The accident is the peril, peril, because what caused that financial loss? is the accident that damaged your car. So the risk is the thing you do that has a potential for loss. Peril is the thing that caused the direct cause of that loss would be the peril. So the accident would be the peril. In the case in the case of life insurance, the peril will be death. Death is what caused that financial loss, right? Because when you die now, you're gone. You're no longer earning money for your family. So that peril will be death. For let's say in the case of homeowners insurance, right? Let's say you're cooking. So every time you're cooking, it's a risk because your house could catch on fire. So you're cooking. So cooking will be the risk. Now, let's say the house catches on fire. So the fire now, the house catches on fire and burns down. So that fire will be the peril because what caused the house to burn down after that loss? It's the fire. And now because the house is burned down, it's reducing value. So understand peril, risks, and loss. Now, and by the way, if you don't understand anything, feel free to interrupt me. Under risks, there are things that increase the potential for risks, right? Anything that increases the potential for that risk is called a hazard. Hazard. Let me write it here for you. Hazard.
Da kan je schrijven peril.
Huh?
Peril.
A peril, right here. P-E-R-I-L, right here. And then
Peril, okay.
yeah, and then hazard is Hazard. Hazard.
You said hazard, risk, anything that increases the risk.
Exactly, it's hazard. So I'll give you an example. So we know that driving itself is a risk, right? Anytime you're driving, like one of my former clients, when I just got in the business, he was a truck driver. He was stopped at a stop sign, and someone just, a drunk driver, just slammed into him, and he died on the spot, right? So even though he did everything right, it was not his fault, but someone just slammed into him, right? So a hazard is anything that increases the potential, or anything that increases your risk, or anything that increases the potential for a loss. So let's give you an example. So we know that driving is a risk, but let's say it is snowing outside, and in the next 2-3 months, it will start snowing, right? So it's snowing outside, it's a blizzard. But it's a blizzard, the speed limit is 40, and you're going 70 miles an hour in a blizzard. Everybody knows you're just increasing your chance of an accident, right? Because if it's snowing, common sense will tell you slow down, right? But it's snowing and you're speeding. So because you're speeding, going above the speed limit when it's snowing, your chance of having an accident, is it increase or decrease?
Increase.
Increase, right? So you speeding will be considered a hazard. Why? Because it's increasing the potential for loss. It's increasing your risk of an accident.
Yeah.
So a hazard is anything that increases your risk of an accident. Now let's bring it to life insurance. So we know that life itself is a risk. Every day you wake out of your bed, it's a risk. You could die. You could even die in your sleep, right? So life itself, just living itself, is a risk. But there are some things you can do to increase that risk. So for example, if you eat fast food every single day, you eat processed food, you eat junk, you don't eat vegetables, you don't exercise, nothing. You just eat McDonald's, you eat Popeyes. I mean, you don't exercise, you don't do anything, right? You just eat junk. We know that if you eat junk and you do that for a long time, the risk of premature death will be increased because all your arteries, and I know a thing or two because I'm a pharmacist. So all your arteries will be clogged from all that grease, and you're not exercising, you're not burning out. So now your risk of death will be much higher, will be increased, than someone who exercises every day, who eats vegetables and all of that stuff, does not eat junk food, right? So those will be things that will increase your risk. Now, on the hazard, so what I want you to do, let me erase this. So here we'll have something like this. So these are general insurance definitions, by the way, right? But again, I'm just laying it off. I'm starting off from the beginning. So here we have hazard. No, we have risks. So you can do something like this in your notes if if you're writing. So we have risks. And then under risks, we have hazard.
Did you know?
Is that 98% of our students pass their life insurance exam. Do you know what the national pass rate is? 50%. So no matter how many times you failed your life insurance exam, no matter how old you are, no matter which part of the country you are from, we can help you pass your life insurance exam. So if you want to pass your life insurance exam without stressing, then enroll in one of our online memberships or book a free one-on-one consultation for more information. Now let's get back to our training. All right. Now, under hazard, we have 3 types of hazards. The first type of hazard we have is physical hazard. Let me just type here, PH, physical. So what is physical? So physical means you're actively doing something to cause it. So for example, let's come back to driving, right? So speeding would be a physical hazard, right? Speeding would be a physical hazard that could get you in an accident. For example, for life insurance, let's just say you're engaging in fights, right? Like maybe you have a gun, right, and you're shooting, stuff like that, and you're having gunfights, right? Those are things that you're physically doing, or maybe you're eating junk food every single day. Those are all physical hazards, right? So those will increase your risks also. They're physical. Now, let's come here to moral. And this is where people get tripped on the exam, because the only difference is 1 letter. So anytime you think about moral, think about honesty, right? When they say, oh, this person has no morals, or this person is immoral, that means that you're dishonest, you don't have integrity, or all of that stuff, right? So when you think about moral hazard, think about honesty. So a very good example that's commonly used on the exam is, for example, someone lying on their insurance application, right? That is a hazard to the insurance company, right? So that would be considered a moral hazard because it will increase the chance of a financial loss on the insurance company part. So anytime your dishonesty leads to increases the chance of a loss, is considered a moral hazard. Let's come here to life insurance. Let me see if I can give a very good example. So a very good example, another one for life insurance. So let's just say your child, right? You tell your child, oh guys, make sure, or let's not even include your child. Let's come here to the husband and wife, right? So your wife tells you, oh honey, make sure you lock all the doors, right? Make sure you lock all the doors before going to bed. But you intentionally, you lie to your wife and say, you know what, the doors are locked, when the doors are actually not locked, right? And you lie to your wife, right? That's dishonesty. But now that dishonesty leads to someone breaking into your house and killing you, or killing someone in your family, right? So that dishonesty that led to that loss will be considered moral, right? Now let's come here to, there's another one. It's also pronounced, people pronounce it morale, but the only difference with this one is that there's an E at the end. So anytime you see morale, this one, just think about carelessness. Carelessness.
But it means like the same thing like physical.
Yes, it's physical, but this one is actually, yes, it's similar to physical. The difference is it's actually carelessness. So I'll give you a good example. Carelessness. So I'll give you a good example. So and this actually happened yesterday. So I went to visit my sister. I was outside, and she left the stove on, and she jumped in the shower, to take a shower, right? She left the stove on, and that's carelessness, right? And then I walk in the house, because I thought, hey, I'm on my way to visit you. So, and I guess it was just God, it was just timing. But she's in the shower, she has the vent on, and she's playing her music loud. The stove is on. And then, I enter the house and the smoke alarm is going off. The whole house is covering smoke. I don't know how she then hear the alarm in the bathroom. I guess maybe it's not loud, but the whole house is covering smoke. And I'm like, what is going on? I go to the stove and she's cooking something is burning, so I turn it off. Right? So that is an example of carelessness because common sense will tell you when you're cooking, you go in the shower, turn the stove off. Right? If you leave the stove on while you go take a shower, that increases your risk of a fire. Right? Or sometimes people will leave the stove on, and those people go take a nap. Right? That's carelessness, right? Or we all know that when you park your car, don't leave any valuable in your car because when people see it, they'll break into your car, right? But you're driving in a parking lot, you leave your wallet on the dashboard, or you leave your credit card on the dashboard, or you leave a $10 bill on the dashboard, right? Someone will break into your car, right? So that carelessness will lead to a loss, right? So anytime, yes, carelessness. So carelessness is morale is similar to physical you're doing, but the key difference is carelessness. Any questions? I know I've covered a lot. Any questions?
Yeah, could you expatiate or differentiate? Because when you explain the morale, the regular morale, the one in the middle,
More okay.
morale, not moral, moral, the one in the middle,
Okay.
you talked about honesty and integrity, and under the integrity, you gave an illustration of a guy, like I think, lying to the wife that the doors were locked, but they were not locked. Is that not also carelessness?
Yes, it's also carelessness, and that's why. And you asked a very good question. So we're going to go over a lot of practice questions. Usually on the exam, people get physical all the time. It's very easy.
Yeah.
But where people get confused is the difference between morale and moral. So we'll do a lot of practice questions. You'll see the difference.
Okay.
Yeah. Josita, it looks like you want to ask a question.
Yes, so I have a question. So, when you talk about hazard is something that is dangerous. Is and then why under hazard we have honesty?
Oh, honestly, yeah. Again, so hazard is not just dangerous, but anything that increases your risk, right? Anything. So sometimes your dishonesty can increase risk of a loss. So we said that. Remember, hazard is anything that will increase your risk, and we said that risk is potential. Risk is potential
Loss.
loss. All right. So a hazard, if your dishonesty leads if your dishonesty increases the chance of a loss, it's considered it's a hazard, but it's considered a moral hazard. So you shouldn't worry. We'll go over some scenario based because most of the time when they ask you these questions, they don't ask you direct. They'll create a scenario based questions like they'll say Eddie, the speed limit was 40, and Eddie was going 70 miles an hour in a 40 miles an hour zone, and this increases risk of an accident. Which of the following, which of the following hazards? Then they'll give you some. So they're not going to ask you directly. They're going to give you scenario based questions, and we'll go over those scenario based questions.
Okay, so
Yeah. All right. So now we'll cover the basics. Now let's come to annuities. So what annuity? Write this down. First of all, what is the purpose of annuity? The purpose of annuity, unlike life insurance, and I'll share with you this document because we went over this with Josita. I'll share with you. The purpose of an annuity is to provide you income for life. Is to provide the annuitant. Let me pull this up here. Okay, perfect. You can see this here, right, Eddie?
Yeah. Can you increase the font a little bit online?
Okay. Let me see.
Yes, it's better now.
You see it? Okay. So again, I'll share with you this document. So this is the difference between life insurance and annuity. So on your exam, they'll expect you to know. They'll ask you some scenario-based questions. So unlike life insurance, the key use of life insurance is to provide your death benefit. right? That is the main use of life insurance. Although people can use life insurance for retirement, for all these other things, but the main purpose for life insurance is to provide your death benefit. And we said these are the other names for life insurance. It can be called face amount, policy proceeds, limit of liability, right? So know those names. Unlike life insurance, annuities, the main purpose of of annuity is to provide the annuitant, not the owner, because people get confused. And I'll talk about who is an annuitant shortly. But it's to provide the annuitant income for life or income for a specified period. So annuity is mainly for retirement, right? The same way people have 401k, Roth IRA, 403bs, you have annuity. Annuity is to provide you income for retirement, right? Income for life or for a specified period of time. Now, can annuities give death benefit? Yes, but that's not the main purpose of annuity. Can life insurance provide retirement benefit? Yes, but that's not the main purpose of life insurance. So let's come here to your exam. I just want to make sure we cover everything on your exam outline. They don't have uses of life insurance on your uses of annuities. That's interesting. I'm still going to cover it because sometimes for Pearson View, your test will be administered by Pearson View. Sometimes they're not very detailed, so they just say a single level, but it's going to be on your exam. So let's go over that. So the uses of annuities. You can use annuities for individual retirement plans, right? Individual retirement is called individual retirement annuities, right? You can use it for that. You can use it to give you tax deferred growth. You can use it for retirement income. You can use it for education funds. So people use the annuities to save for their kids' college. You can also use it for a charitable gift. You can say, okay, I'm going to use my life insurance. I'm saving money there, to give to charity. So these are all the uses for annuities. Any questions so far?
The tax deferred growth. Did you?
Yes. So tax deferred growth, just like 401k, when you put your money into an annuity, it's growing tax deferred. That means they will tax you, but not while you're putting the money there. But when you go to take it out, then they tax you. That's what tax deferred growth means.
All right.
All right. So now let's come to the players here in annuities. And I think let's go here to your outline. Again, okay, so Maryland has here on the outline owner, annuity, and beneficiary. They don't have it there, but they're not going to ask you directly, but they will expect you to know. So let's go over it. So you have three players in an annuity, just like life insurance. You have your beneficiary, you have your insured, and you have your owner. Again, I'll share this document with you, but you can just take notes and stuff because I already went over it with Josita. So the policy owner.
One question.
Yeah, go ahead.
Are you talking about annuity or life insurance right now?
Well, I'm comparing and contrasting the two. Yeah.
Okay.
So for life insurance, we have the owner, but in life insurance, we call the owner the policy owner. Why? Because your life insurance contract is called a policy, right? So the owner of life insurance is called policy owner. That means you own that policy, or policy holder. Again, they use the same thing interchangeably, means the same thing. So just know that the owner for life insurance is the one who has all of the rights, right? It's the person who applies for insurance. So the owner applies for insurance. Again, we're comparing and contrasting life insurance and annuities. So the owner applies for insurance. The owner has all the ownership rights. What are some of those ownership rights? They are responsible for paying the premiums. They are responsible for canceling that policy. In insurance, when you cancel, it's called surrender, right? Like if you're a Christian, like you surrender your life to Jesus. So, you gave up, right? So when you surrender, you give up your policy. It's called, it's called surrender. That means you're canceling or terminating your policy. The owner has the right to request loans if it's a cash value life insurance policy. The owner has the right to make withdrawals. They have the right to assign beneficiaries, to change beneficiaries also. For life insurance, they also have the right to sell their policy, because some people don't know you can actually sell your life insurance policy. Yes, you can sell your life insurance for cash, right? So the owner has the right to sell that policy, they can also transfer ownership. And this is what I usually recommend to parents, right? When you get life insurance for your child, of course, your child cannot be the owner because they are minor, they're under the age of 18. So you will be the owner, they will be the insured. But when that child graduates college, then you can transfer ownership to them. So that's what my mother did for me, right? She got insurance for me, she was the owner. When I got to college, she transferred ownership to me, right? And I was able to use that to save money, and that's what I used to get my first property, money from it to get my first property and second property and all of that. So you can transfer ownership. So you, the owner, can do all those things, right? Now let's come to annuity.
Sorry, sorry to cut you.
No, no problem.
Can you I know it's we don't need to go too deep now because you're trying to make the difference. But can you explain when you sell the policy? I know you explained transfer. It makes sense. You can transfer to your child. It makes sense. But about the selling, how you sell the policy, you just sell it without. Then how do the insurance company do the change of the name and all that in the policy? What's the
So let me come here to exam Alan. Let me see if we have life settlement. Okay, perfect. So it's on your exam Alan. This is in part 2, so we'll get to it, but I'll just go very briefly. So life settlements, right? So insurance company allow life settlements, right? They allow you to sell your policy. So what happens is you have 2 types of life settlements. You have one, just a regular life settlement, and you have one called a viatical settlement. We'll go into details when we get to this part.
Okay.
But pretty much what that is let's just take the viatical settlement, for example, right? So if you're sick, and we know that medical bills are the number one reason people go into bankruptcy in this country. So you're sick, you don't have money, you need to pay your medical bills. Now you can sell your life insurance to third parties. There are actually companies out there that will buy your life insurance. So how it works is it's something called investor-owned life insurance, IO, ORLI, investor-owned life insurance, ORLI, OIL. Let me use something here. It's called ORLI, OILI, investor-owned life insurance, right? So now you will be selling your life insurance to investors. So now you're sick. Let's say, God forbid, you're sick. You have your life insurance. Most of the time, it's cash value life insurance. And let's say you have, I don't know, let's say you have $20,000 in your cash value, and let's say your policy is $500,000. Your death benefit is $500,000. So the insurance company will say, okay, Eddie, we know you need some cash. You want to sell this, so we'll give you $100,000. We'll give you $100,000. So now you will turn over ownership to them, and then they will now be the owner and the beneficiary. So they will now take over premium payment. They will be paying the premiums. You don't have to pay the premiums anymore, right? Because if you're strapped for cash, how will you be paying premiums? So they will now be the owner. You will still be the insured, but they will be the owner. They will be the beneficiary. So they will take over premium payment, and then they'll give you $100,000 cash. It's not a bad deal. So let's say you pay a total of $10,000 or $5,000 premium. Now someone is giving you $100,000 cash. Not a bad deal. The only thing is now when you die, instead of the beneficiary getting $500,000, they will get that $500,000. So usually this is done with people who are seriously sick or people who are old. They won't do this for a young person like 20, 30, or even 40 years, right? Usually people 60 and above, because those people don't want to pay premiums for more than 10 or 15 years. And then when you die, boom, it's a profit for them. So it's called investor-owned investor-owned life insurance. Any questions? And then you have so that's for viatical settlement. Then the life settlement, the regular life settlement, you don't have to be sick to sell it. You can go online and search their companies. Once you work out a deal with them, you inform your life insurance company. They will send some paperwork. You have to sign. You have to notarize it. Everything, something. Both, all three parties will sign. The insurance company will sign. You will sign. That company you're selling to will sign, and then you can sell it to them. So a lot of people don't know, but this is a way to make some extra money.
So are you the one looking for them, or they are the one looking for you?
Or sometimes they will call you, right? But usually, they target senior citizens because, I mean, we all know that the older you are, the higher your chance of death, right? So they're not going to target people who are 20 or 30 years old life insurance. So usually they target people in their 60s and 70s of life insurance, right? Because they figure out, okay, this person has 10 to 20 more years to live, so we can buy the insurance. And then, because their goal is to make a profit within 10 to 15 years, no more than 15 years. Because they assume, let's say if you're 70 years, so okay, all things being equal, you probably don't have that long to live. So they'll buy it, be paying the premium, and then when you die, they cash in. But they can also sell to young people, assuming you're seriously sick and they believe that you don't have that long to live then. Because remember, it's a business for them.
Mm-hmm.
Yeah. Any questions? So, all right, so let's go back here. All right, so we said that for annuities, in annuity, we don't call the owner policy owner or policy holder. We just call them owner, or we call them annuity owner, right? So the same thing applies for annuity. So the owner is the person who applies for the annuity contract. Just like life insurance, they have all the ownership right. They are the ones who pay the premium. They can cancel that policy if they want. Because if you own something, you have the right to cancel it, right? So they can cancel that policy. They can request loans. For example, if you own your house, you can get a home equity loan on your house. But someone who doesn't own your house, will it make sense for that person to go and get home equity loan on your house? No, right? So it's the same way. So they can get loan from the policy. They can make withdrawals. They can sell or transfer ownership of that annuity. They can assign beneficiaries. They can change beneficiaries. Let's see if beneficiaries will be on your exam. I'm just beneficiaries. Okay, so change of beneficiaries is on the Georgia life insurance system. Okay, so we'll cover that later. But they can change beneficiaries and do all of those things. Any questions on that one? All right, so now we'll come to insured. So what does insured means? Insured is the person whose life that policy is written on, right? So insured, let's take life insurance. Insured is the person who the insurance company will take their life and say, okay, based on your age, your health, and everything, we decide to approve you or not approve you. Most of the time, the insured is the same as the owner. So, for example, Josita, you go and get life insurance on yourself. So you are the owner of that life insurance and you are the insured, right? But sometimes you can have someone else as the insured and you the owner. So if that happens, it's called third party ownership of life insurance. Let me see if that's on your exam here. Third party. Again, so sometimes these topics will cross over, right? So even though I'm talking about annuity, I'll be talking about beneficiary. Again, we'll still go over it, but you hear one time, maybe a few days from now, we'll go over it. You hear the second time, it'll stick, right? So let's see if third party is on your exam. Third party. I thought it's interesting. It's not on yours.
I think it was there during my exam.
Oh, it was there. You saw it on your exam, right? Yeah, because I know that's on the Maryland exam. I don't know why it's not coming up on my search here. Let's check. Eddie. Oh, okay, yeah. So this is on your exam too, Eddie. So third party ownership of life insurance. So anytime the owner and the insurer are not the same, it's considered third party ownership of life insurance. So let's say, Eddie, you get life insurance on your wife. So you are the insurer. No, you are the owner. Your wife or your spouse or girlfriend is the insured, right? So that would be considered third party. Because think about it, third party means it's not you, there's someone else, right? So anytime someone else is the insured, it's considered third party ownership of life insurance. So there, most of the time they'll give you these three examples on your life insurance exam. Write it down. Number one, spouse. So you get life insurance on your spouse, right? Husband gets life insurance on his wife. Wife gets life insurance on the husband. That's third party. Just see that? I don't see you taking notes.
No, sir.
Okay. So that's third party. Also, second, you get insurance on your child, right? Most of the time, parents will get insurance for their children, right? So you are the owner, your child is the insured. So that's the second example. Third example, you get insurance on your business partner, right? So that's considered third party ownership, right? And your business partner will get insurance on you. So those are the three examples they usually use. Get insurance on your spouse, get insurance on your child, get insurance on your business partner. All right. Any questions? All right. Let's go back here to our something. So we said that the annuity owner has all these rights. Now, the insured, as I said, is the person whose life the insurance contract is written on, right? So the insured is also the person who has to die for life insurance, the person who has to die before life insurance benefits are paid out. So for life insurance, the life insurance benefits cannot be paid out until the insurance dies. Now, there are some exceptions, and we'll go into that in details when we come to it. There's something called accelerated death benefits, right? So accelerated death benefits, again, I want to stick on annuities and life insurance difference. But accelerated death benefit, where, like example, if you have terminal illness, right? Terminal means you have less than 24 months to live. It's been like your doctor has written and confirmed. You have a licensed professional, medical professional, say you have less than 24 months to live. Then the insurance company can give you sometimes up to 100% or even 90% of your death benefit while you're alive, right? And that is a standard provision. You see here, this is under provisions. This is under policy provision. So it's a standard provisions with all life insurance policies in America, whether it's term or cash value, permanent, it doesn't matter. So again, as an agent, you got to know this, right? If your client has a terminal illness, they don't have to wait to die. As long as it's something certified in writing by your doctor and they have life insurance, they can take up to at least 90% of that death benefit while they're alive. That's accelerated death benefit. And then under that, you have long-term care. Again, we'll touch on this, long-term care. Okay, so long-term care is on your exam. So these are all under policy riders. So accelerated death benefit, then it comes in when you have long-term care rider. We'll talk about that later. But just know that for your exam purposes, the insurer has to die before death benefits are paid out, right? Now, for annuity, the insured is called the annuitant. That's the key difference. In life insurance, we just call the insured. In annuity, we call the insured the annuitant. So the main purpose of annuity is to provide income. Very important. They trick people on this one, right? The main purpose of annuity is to provide income to the annuitant. Unlike life insurance, the main purpose of life insurance is to provide income to the beneficiary or death benefit. For annuity, the main purpose is to provide income to the annuitant. The annuitant is the insured. Now, most of the time, the annuitant, just like life insurance, is the same as the owner, right? The policy owner can be the same as the insurer, right? Most of the time. But sometimes the annuitant can be different than the owner. So let's come back here to annuity. I just want to. Okay, yeah. So combination plans, right? Under annuities, right?
Says today.
Yeah, they are different. I'll go over those later. But sometimes the husband and wife can get annuity. So maybe the husband is the owner then the wife is the annuitant, right? Or it can be vice versa. The wife is the owner, the husband is the annuitant, right? So sometimes you can have more than one. Again, we'll get to it. It's called combination plans, and you have combination plans in life insurance also. But we'll get to that.
So when you say joint life, it means that it's couples or what? And then first to die another person.
Yeah, most of the time it's couples, but
Or it's a couple.
yeah, we'll get to it. I think it's on your exam outline too. Joint life, joint life.
Single life and it change to person.
I saw it somewhere here on your exam outline. Joint life. It should be here on your exam outline. Joint. Interesting. Death benefits, life contingency.
Maybe they will move it this year.
Oh no, right here. It's here. Single life versus multiple
Life, yeah.
So they say multiple life for Georgia. They say joint life is the same. So we'll cover it later. But just know that the annuitant is the person who is insured in an annuity contract, and the purpose of an annuity is to provide income for that annuitant, not for the owner, not for the beneficiary. Also, important thing to know is the annuitant must be a natural person, must be a human being. The annuitant cannot be a company, cannot be an entity, nothing. It has to be a natural human being. You're going to see this on the practice questions, right? All right. Now let's come here to the beneficiaries. We all know the beneficiaries, right? The beneficiary is the person who receives the benefit. So for life insurance, the beneficiary, for both life insurance and annuity, beneficiary has no rights. Write this down. Beneficiary has no rights. In whether it's a life insurance or annuity, the beneficiary has no right. All they're there to is just wait for the insured to receive the money. So in the case of annuity, they're just there for the annuitant to die for them to receive the money, right? But they have no rights. Any questions? All right. So thank you very much for watching. If you're watching this on YouTube or if you're listening on the podcast, thank you very much. We are doing something amazing here. Our pass rate is 98%. So 98% of our students pass their life insurance exam with flying colors. The national pass rate is 50%. Last year, 200,000 people failed their life insurance exam. And some of those people who failed, some of them studied for up to 2 months. Some of them have a master's degree. So they didn't fail because they didn't study hard enough. They didn't fail because they were dumb. No, they failed because they didn't know the system, right? They didn't follow the system. And to pass this life insurance exam, there's a system. The good news is we've cracked that code to pass your life insurance exam. As I said, our pass rate is 98%. We've helped students pass their life insurance, people who have even failed their exam up to 7 or 8 times. They've come to us, we've helped them pass. We've helped people as young as 18 years old pass their life insurance exam, people as old as 67 years old pass the life insurance exam, people from almost every single state, from Washington to New Jersey, New York, California, you name it, all across the United States of America. We have helped people pass their life insurance exam, and you will be our next success story. So if you don't want to fail your exam, like 200,000 people last year failed their life insurance exam, then book a one-on-one consultation. That consultation is free, or you could just click the link in the description and sign up for one of our membership programs or sign up for our self-study. Until next time, we wish you all the best on your life insurance exam, and we wish you a successful insurance career.